Dollar cost averaging is like an iceberg. Most of the danger sits right below the surface. It feels simple to automate, it's easy on your cash flow, so people treat it as set and forget. But that mindset can quietly set you up for a tax time disaster. Every little buy becomes its own tiny bucket, and do that monthly for 3 years and you've got 36 buckets. Then, the day you sell some, you're juggling dozens of mini profits with different dates and different tax rules, giving you hours of admin and often more tax than expected. In this video, I'll break it down with a real 3-year 36 bucket example and show the one workflow that keeps it painless. So what's really happening? When you buy regularly, each buy is its own parcel, its own date and cost base. After 3 years of monthly buys, you're not holding one simple line item, you're holding 36 little entries under the hood. And here's the kicker, tax is assessed at the parcel level, so when you sell a slice, you'll likely touch lots of them. Why this gets painful? To record just one sale properly, you need to figure out which parcels are involved, split the units across them, rebuild each cost base and apportion fees, check which ones are older than 12 months, and for ETFs, reflect any AMIT cost base adjustments in the calculation. It's a lot of steps and a lot of places to make mistakes. A quick primer for Australian investors, if you've held units more than 12 months and you're an individual, you may be eligible for the CGT discount on the capital gain component. If the holding period is under 12 months, no discount. ETFs can issue AMIT cost base adjustments which increase or decrease your cost base and can flip a parcel from gain to loss, even if the market price didn't move much. So let's make it concrete. Say you bought 10 units every month for 36 months. That's 360 units in total. And today you sell 180 units at $150. So the same sale value, but your tax outcome depends on which parcels ended up in that 180. A sale like this doesn't grab one neat block, it grabs pieces across many parcels. And depending on which mix of parcels ends up in the sale, your taxable result can move quite a lot. So mix A is FIFO, or first in, first out. This pulls from the oldest parcels first, and older parcels often have lower purchase prices, so the gains appear larger, even when some parcels qualify for the long-term CGT discount. In this illustration, the capital gain is about $8,000. Mix B is the minimized gain strategy. This leans into higher cost parcels and any loss-making ones to reduce the overall taxable outcome. Same 180 units sold, different parcel mix, different result. Here the realized gain is about $5,000. So the same sale, but a $3,000 difference. But there isn't just one right way to sell. There are many possible parcel mixes your sale can effectively pull from. Here are a few of the common CGT calculations you can use. LIFO, or last in, first out. This emphasizes recent, often higher cost parcels, usually fewer parcels than qualify for the 12-month discount. Minimized gain is the highest cost first, so it specifically targets parcels that minimize taxable gains now. Maximized gain is the lowest cost first, so the opposite, can accelerate gains if you're deliberately realizing a large profit. And then custom, you handpick parcels to align with your cash needs, holding period windows, or year-end planning. Whichever mix you use, you need to identify it, document it, and reproduce it later. If you hold ETFs, AMIT statements matter. They can adjust your cost base up or down. It's not a fee or a distribution in the normal sense, it's a tax accounting adjustment. Practically, it means two things. One, your recorded cost base per parcel might change after the financial year. And two, a parcel you thought was a small gain might become a small loss, or vice versa. So if you're doing this in a spreadsheet, you need to layer AMIT adjustments onto the exact parcels they apply to, not just the holding in aggregate. Miss that and your tax figures will be way off. Brokerage and transaction fees. These need to be apportioned to cost base and proceeds. When a sale spans many parcels, each parcel's share of the sold units should get its fair slice of the fees. Otherwise, your gain or loss per parcel will be calculated wrong. Again, doable by hand, but fragile and time consuming. Let's compare the manual approach with an automated workflow. So the manual way is you export your entire trade history, map sales to parcels, allocate units parcel by parcel, apportion fees, check holding periods, overlay AMIT adjustments, compute gains parcel by parcel, Then build a report you can actually hand to your accountant. The automated way is you import your trades, preview the parcel mixes, pick the mix that fits your goal, and generate a CGT report that matches the preview. Let me show you. So in Navexa, we've gone into our VAS holding, and if you look at the Trades tab, you can see all the different parcels that we've opened up for the last several years. So you can see each one of these has its own date, a different price, a slightly different number of units, and a different cost base overall. So that it means later when we make a sell trade, in this case, we've sold 53, which 53 are we going to sell? And it's important we can record these accurately, because next time we sell some more, we need to know which parcels we've already sold. So with all this data in, we can navigate to the capital gains tax report, and you can see for the 24-25 financial year, it has already calculated this sale trade for us and given us an overall capital gain of $3.49. So you can see it's split it into the 53 different units across 5 different parcels, and each line item here represents a different parcel that it's sold. Now we can go into tax settings, and instead of using a first in, first out or a FIFO strategy, we could change to a minimized CGT strategy, hit update, and now we have a $101 capital loss, which, if you know, you don't pay tax on a capital loss, and a capital loss can even be used to offset other capital gains. So now you can see we have 5 different parcels sold to make up our quantity of 53, and it's selected ones with the highest price first, or the parcels that are going to result in a capital loss. So it gives us a very different outcome with the click of a button. You can also experiment with other strategies. So you could do a LIFO strategy, and that again gives us a capital loss because it's using the most recent parcels first, but not as big of a loss as running a minimized CGT strategy. I mean, also, if you would like to realize the most gain and get rid of those winners, we can run a maximized gain strategy, and you can pay a full $283 in capital gains tax. And this is useful if you want to get rid of those big winning parcels early on, so that you're only left with the higher cost parcels later to reduce your tax bill in future years. Year-end and cash flow tips. A few strategic considerations to think about before you hit sell. One is the CGT strategy. Are you trying to pay more or less tax this financial year? Are you wanting to get rid of cheaper parcels or more expensive ones? Timing. If a big block of parcels is just shy of 12 months, waiting can change the after-tax outcome quite significantly. Rebuying. Be careful with rapid sell and buyback behavior, because wash sale provisions are going to apply. Records. Keep broker statements and ETF tax statements. They're the source of truth for AMIT and fees. Here's 5 quick habits to stay in control. So 1, know which parcels are inside or beyond the 12-month window. 2, keep your statements. ETF AMIT adjustments can change the cost base. 3, always preview before you sell. 2 minutes here prevents nasty tax surprises. And 4, document the selected parcel mix so you can reproduce it later. And 5, generate a proper CGT report and file it with your records. So DCA is excellent for building a position, but it also builds parcel chaos beneath the surface. When you go to sell, you're really selling pieces across many dates under different tax rules, so preview the parcels, know the impact before you sell, and avoid the surprise at tax time. Thanks for watching. Check out our next video.